On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. We have a lot of clients that are from a farming background, either past or present. They're great people, and many have spent decades overcoming a plethora of challenges to build very successful businesses. When the time does come to think beyond the farm, investing in a portfolio dominated by shares, listed property, private equity, and fixed income doesn't always come naturally. Having less control and influence is a mental hurdle for some, while diversifying far and wide can also be quite a new concept. However, farmers and ex-farmers that can get their head around these differences often become very, very astute investors. So in the spirit of field days, which begins next week, I want to give you 6 reasons why farmers make very good investors. The first one is that they appreciate that risk can come from anywhere. Now, farmers can be cautious, slightly cynical at times, maybe even a little grumpy. You'd never hold that against them, and that thoughtfulness often serves them very well. Farmers have an awful lot of risks to consider, many of which are outside their control. You've got commodity prices, interest rates, and the currency. Those are obvious ones. These things are often driven by global factors that are very difficult to predict. Government policy changes, they're always an ongoing risk, most obviously here at home, but also offshore. If regulations or incentives change in other countries, that can impact the cost structure or supply response from other regions. Then you've got the weather. Even if you get everything else right, a bout of bad weather can torpedo an entire season. Share investors have an equally long list of things to worry about, so they've got that in common with farmers, and many of those things are just as difficult to predict. So, like farming, investing success is as much about risk management as it is about picking the right stocks or forecasting where markets are headed. Reason number 2, farmers know that the long term is much more important than the short term. Now, keeping your eye on the long game can be difficult, especially when you're in the thick of a bout of market turmoil, but it is non-negotiable for any long-term investor to maintain that long-term view. The return from US shares since 1945 has been just over 11% per annum, including dividends, and we've had positive returns coming in any 12-month period 78% of the time, so it's not a bad track record. However, over the short term, the variation can be huge. The best 12-month period was a 60% gain, and the worst was when US shares fell 41% during 12 months. That was in the GFC. And it's not totally dissimilar with farming. Anything can happen over the short term in farming, and the odd bad year is simply par for the course. But like a great piece of land, a good quality share portfolio will just about always do well over the long term. And that's the period that most of us are investing for, the long term. The hard bit is keeping your cool when the short term is looking much more difficult. Reason number 3, farmers understand that fundamentals will always trump fads. Now, fashion and fads will always come and go, and along the way, prices and valuations can get out of whack, because markets can become overly pessimistic or overly exuberant. You always have something new that is flavour of the month, or the flash in the pans that tend to come and go over time. However, the value of an asset is ultimately a function of the cash flows and returns that it will generate, even if some of those are some way off in the future. Investing in quality assets that are difficult to replicate, that generate solid returns, and that are exposed to long-term structural trends will always trump jumping on the latest bandwagon. Reason number 4, farmers have a history of innovation. Now, New Zealand is blessed with a climate that lends itself to very successful agriculture, but our farmers have also been very innovative over the years and the decades, and in part this was forced upon them after farm subsidies were removed in the 1980s, and that was during a time when other parts of the world were benefiting from more generous government support. This need for constant improvement, innovation and reflection will resonate with investors because if we look at the world's most dominant companies from 20, 30, 40 years ago, very few of those would find themselves on those same lists today. The farming landscape will continue to evolve, as will the economy, while share markets and companies require constant scrutiny. And those who embrace change and accept that nothing is set in stone are best placed for continued success. Reason number 5 why farmers make good investors: they understand that leverage can be a double-edged sword. Now, the financial term for using other people's money to invest is leverage. And that works really well when asset prices are rising. In those times, leverage can make you very wealthy. It supercharges your returns. But in a flat market or a falling market, high debt levels and lots of debt, lots of leverage can do the opposite because it can also magnify your losses. And many farmers will have lived through an era of much higher interest rates than we've got today. And some will have seen their peers get into trouble by borrowing too much, over-leveraging or overpaying. And when it comes to looking at and analysing companies or businesses to invest in, balance sheet strength and an ability to ride out any potential downturn or recession, or at least prove more resilient during those periods, are key attributes that investors should look out for too. Reason number 6, last one, but arguably the most important, is that farmers recognise the need for growth assets. And the reason this is such an important concept is because of inflation and the fact that we all need to protect our purchasing power and our wealth from the impacts of inflation. Many farmers will remember the 1970s and 1980s when inflation was running at an annual rate of more than 10%. And even at much lower levels, even at say just 3%, inflation is still the enemy of investors and those looking to maintain their spending power. At 3% over 10 years, you will see the value of your capital reduced by more than 25%. Now, land has always been a great asset for those looking to insulate themselves from inflation, but growth assets like shares or listed property or interests in private companies can help to continue that as well after you've sold the farm. If we look back over the last 50 years, New Zealand shares have returned 9.6% per annum, including dividends. And over that same period, the average inflation rate in New Zealand has been 5.5%. So remember, you had very high inflation in the 70s and 80s, then it slowed right down from about 1990 onwards, and over the last 2 or 3 years, it's been high again, but is coming down. So over that whole period, been about 5.5%. Over that same period, 50 years, New Zealand shares have done just shy of 10%. What that means is that the local share market has provided a real return, and when I say real return, I mean the return you get in excess of inflation. That's your real return you've got after the impact of inflation. That's been about 4.1% per annum. So shares provide returns from capital growth as well as from dividend payments. And your capital growth comes from a rising share price, while the dividends are that income stream that is paid to you by the company out of the profits that it generates. And great companies will endeavour to steadily increase their earnings and their dividends over time, which provides investors with another element of inflation protection. So those are my 6 reasons why farmers make very good investors. I'm sure there's more, but we've chosen to talk about just those 6. If you're a farmer and you'd like to talk to someone about your options, please get in touch. Like I said, we've got a lot of farming clients. We love farmers. And many of the things that people in farming have learnt over the years do lend themselves to making for very good investing as well. So please get in touch. We'll talk again soon. Thanks for listening.
For more insights, visit craigsip.com.